Morning, everyone. Talking to you from Pereira, Colombia. This is where it's coffee country here. So I'm here for a couple weeks trying to just explore more of Colombia now that's more opened up and everything. And yeah, I'm about to leave the country soon as well. So I'm just trying to see some things after being in quarantine for a while. So left Medellin on Friday, and now I'm here in Pereira. Definitely a lot of different nature things I want to see. So follow my Instagram if you want to check it out, or just check out this Facebook page as well. Or if you're watching this on YouTube, yeah, just go to Facebook page or my Instagram. Just type in Grow with Joe, and you can find it there. But today, what we're going to talk about is a personal finance, financial planning topic, and that's like, what is the difference between active managed funds and passive managed funds? So the main difference between the two is that it's in the title. Active managed funds means there's an investment manager that is actively choosing the stocks on a consistent basis. They might be like, oh, we want to only have 100 stocks in this fund, or they'd be like, oh, next year we want to put 200 stocks in here. And so anytime there's trades and everything, there's costs associated with that in terms of buying and selling and everything. So, so that's so that's basically an active managed fund. So if someone thinks this is not a recommendation or anything, but let's just say, just for example, hey, I think Tesla is really going to do really amazing, or Amazon, or Nike, or Microsoft, or Hertz, that the car rental company, or just like any company. Like, hey, I think this company is going to do really well, so I want to make sure that I'm overweighted in the stock. So maybe instead of making it like 5%, I'm going to make it 10% of the portfolio, so that so the portfolio, if let's say that one of those stocks increased by 10%, then that is going to increase the value of the fund by 1% instead of half a percent. But there's a risk associated with that in terms of active managed funds. And the key thing with investing is you have to have a long-term perspective with investing. You can't just go from year to year. A real investment strategy takes like 10 years to implement. Yeah, 8 to 10 years to implement, because you have to go through the upswing and you have to go through the downswing as well to really see the value. Because the argument with active management is you get overweight, and you're supposed to have all right, back. Internet's a little spotty here, but I can't remember what I said. Like, so basically, with active manager, you get that downside protection. So basic is you have an investment manager. You say, hey, I'm going to put this fund. I trust you to do better um, than the alternatives out there in term when it comes to investing. When you look at passive, that's what it is. It's you follow an index. So one pretty common one is the total market and the S&P 500. So the S&P 500 index fund, which is a passive fund that you could do, is be like, hey, I'm just going to follow this index of these top 500 companies. So like, look at Amazon, Google, Netflix, Facebook, Microsoft, Nike, all the 500 largest companies in the United States are going to be in your portfolio. And so if you look at those 500 companies, and let's just say Amazon makes up 2% of that value, then 2% of your index fund is going to be invested in Amazon. And so the manager in that index fund is just going to be like looking at the numbers like, okay, let's see how far, like how close can we get to uh, the index to see how valuable it is and everything. So you just follow the market. So if you believe that these 500 largest companies are going to do well over the next 400, I mean, over the next 30 years, 40 years, and everything, then that's a good place. But the key thing is, like when 2008 happened, what the market went down by like 40%, 45%, and it took 4.5 years to recover. And so you got to look at the downside protection. Like, hey, do I really want to wait 4.5 years to recover my money? If you're a young investor, then there's something called dollar cost averaging, where you're like, hey, it's 2009. I can really buy a lot of these shares really cheaply. So then when it recovers, and was it 2013 and everything, then you can really benefit from that. So as a young investor, that makes a lot of sense. Uh, but if you're someone closer to retirement, hey, maybe you want to have some different funds inside of your passive fund. You might want to just not have the S&P 500. You want to have some other funds in there, like the total market. Total market is like 3,500 companies inside of it. Then you could go even into more niches where you're looking like, hey, I want to look at all the companies that are worth under $2 billion, and I want to invest in those. There's risk and everything, so please do your research or consult a professional before you make any changes. So that's the like the passive index fund is just looking like, hey, I want to look at this broad sector. Like you look at a healthcare one and be like, hey, I want to have all the healthcare companies and track those, and that's going to be my index fund. So just like, hey, if one healthcare company is makes up 5% of the value of all the other healthcare companies, then your index fund is going to be 5% of that portfolio. An active managed fund is be like, no, instead of having 100 of these healthcare companies, I'm only going to choose the 20 that I think are going to do the best, or it could be the whole 100. It all depends on the investment philosophy of the investment manager and everything. But when it comes to long-term performance, and passive funds tend to do better than active managed funds. That's not saying there are active managed funds out there that could do better and everything. So it all depends and everything and what type of risk. Like if you want to look for a higher return, then you would go for an active managed fund. But there comes that risk that says like, hey, I might not get the return that I want. And there's other things like dollar cost averaging that could affect your performance and like downside protection and everything. So it all depends. But like if you're looking for uh, a a pretty reasonable return, like where you're not where you're taking the least amount of risk, then I would say that that passive route is the way to go. The key thing also as well is you can't have passive investing without active investing. So you need those active investors out there saying like, hey, and you got the individual traders as well that's saying, hey, I believe that this company is going to do well and everything, so I'm going to invest that. And so then that causes the value to go up and down for that one stock. But the passive managers be like, okay, I just follow it. I don't care what's happening with these active managers. I'm just going to follow this one path. So as you can see, like the strategy is much more disciplined with the discipline. So you just like, okay, well, however the U.S. economy is going to do, then that's how I benefit from investing in the stock market. So, and the key thing is no matter how well the stock market does, if you're not investing, it's not going to, you're not going to be able to benefit from that. So, with a lot of firms right now, you don't need a lot to get started. You could get started as low as like 25 bucks per month and everything. I think Betterment, you can invest like 25 bucks or something like that. And you can just start investing in their portfolios. They're a robo advisor. They have different like and then all an aggressive portfolio is 100% stock. A conservative portfolio is probably like 40% stock and 60% bonds because you like when the market goes down like it did in 2008, instead of going down 40%, hey, it goes down 15% and then your money recovered in 6 months. So it all depends on where you are in life and what your strategies, what your goals are. But the key thing is the three things that help you invest in the stock market is time in the market, how much you invested, and your rate of return. The two things you can control in that situation is how much you invest and how soon you get started. The thing you can't control is rate of return, but you can have strategy to be like, hey, I'm focused on getting this higher rate of return, and there's more growth opportunities in these selection of funds than this one over here. So and one of the stats I like to tell people a lot is bond stocks outperform bonds 99% of the time over a 90-year period. So if you have 30 years to invest, then probably you want to go more investing. But you got to just realize like, hey, this is general information. Please do your research before you do anything. Um, and but yeah, when it comes to active versus passive, you probably want to go the route of passive if you're not really familiar, active if you feel like you're doing your research or you have someone to help you out and everything. Another thing with active investments is the fees. Fees tend to be a lot higher. So you can look at an active managed fund and it could have a fee of 1%. Um, and it could also have a front load charge depending on how you got it. If you got it from a broker, they could charge a 5.75% sales charge. So if you put $100 in there, $5.75 goes to the broker for giving you that advice and helping you select the right funds and set up the account and everything. Um, and then you have the internal fees underlying with is like, hey, this is what it costs to do the research and hire the people to do that. So within a passive fund, the internal fees might be like not 1%, it could be 0.01% or 0.05% or zero fund like Fidelity has zero zero like they're very low. They're like 0.01%. So like 1/100th of 1% is the fee. So with an active managed fund, so the thing that helps with that goes against that is that 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 fund has to outperform that fee and the passive as well and everything. So the fees you have to overcome those fees, especially with the sales charge and everything. That 5.75, there's break points and everything. But it all depends. Like, hey, if you're paying for a sales charge, but you're not paying a separate financial planning fee, then that fee might be worth it and everything. So you just have to know the deal before you accept the deal and everything. But with the internet, like those fees were set back in the 90s, back in the day when we didn't have the internet. But now you have investment platforms like Robinhood, Fidelity, Vanguard, and everything, robo advisors like Wealthfront, Betterment to help you start getting invested sooner where you don't have to have a bank. Like it's a lot easier today than it was 10 years ago, 20, especially 20 years ago. But the key thing with the passive tends to be lower fees and they tend to outperform active managed funds over most of them outperform the active managed funds over a long period of time. Active managed funds, it's like, hey, if I want but like with passive funds, you're not going to surpass that rate of return, whatever it is. But if you want to go after a higher rate of return, active managed funds gives you that opportunity, but you're accepting more financial risk in doing that. So it all depends on what your goals are and everything. But make sure you're reaching your retirement goals first, and then anything else. Then make sure then you can accept more financial risks. And um, If you want me to take a look at your investment portfolio, be like, hey, this is what's good about it. This could be room for improvement. Just send me a message here I'll set up an appointment at growwithjoe.me. Start here. You can set up an appointment with me. Just click on my calendar and be like, hey, can I take a look at this portfolio? Can you take a look at this portfolio and be like, hey, what should I do? You give me a list of your other portfolio choices and like, hey, just do this, and everything just to get started. So hopefully that explained the difference between active managed versus passive. Um, it's takes some like you just got to know the deal before you accept the deal, but just realize like it's probably the easier path just to do the passive route because you're just following how well the U.S. economy is going to be. I know COVID is happening right now, but this is just like over the next 1 to 2 years. I'm 34 years old, and I realize like, hey, I'm not going to probably retire till like I'm in my 70s because I love what I do and everything. And I know that other things are going to go wrong in this world. Was it 2000 last thing that we had like over the last like couple years? It was the debt crisis, like the federal debt ceiling that caused the market to go down like 10%, 15%. What was that in 2009? 2000 was it? No. Yeah, it was 2018 that happened. Was it 2000? Yeah, 2018 that happened. The debt ceiling went caused the market to go down, and then we had the Great Recession 2008. Then we had the tech bubble in 2000, and then we had the foreign exchange crisis and like with Russia and Mexico, I believe, in 1996. Then we had the like October Black Friday or Black Monday or something like that in like 1986 or 1983. Markets go down, but they went back up. So then we had stagflation in the 70s, where the market was just flat. We had high inflation and high unemployment. Then we had like the Vietnam War. Then we had the Korean War. Then we had the World War II, and then we had World War One, and then we had the Great Depression. Like something's gonna go wrong in the future, but just realize like just be disciplined about your investment strategy. Realize like, hey, this is only a slice in time where we're looking at things, and if you really want to just be disciplined with your strategies, know where when it's time to play, when it's time to pull your trips away and everything, when it's time to change your strategy and everything. But hopefully that explains a little bit about investment versus active managed versus passive and how it ties in with your investment plan and how things are going to change and everything. So let's see what happens in the future. And uh, yeah, just enjoy the rest of the day. And remember, if you go with Joe, you can grow with Joe because Joe knows Joe. Enjoy your day and take care.